Am I the only one on the air? I might be the only one on the air. Everyone can see and hear you is what the message says. But no one else is there. It's just me. Nick is,
We're not only talking to the prophet. Turns out prophets aren't real. There's been what? How many gods have there been, Jeff? Like 3,000, 4,000 different gods?
You're asking me that question? Do we have a catalog or encyclopedia we can turn to or something like that?
We brought on Jeff and Emil to talk about religion. Got you 1-0, everybody, 1-0.
Yeah.
We're gonna dispense with the frivolities. We're gonna have fun today. It's gonna be kind of a cool macro discussion. We've got Jeff Snider from Alhambra Partners, the head of global research. Is that a fair assessment, Jeff? Is that what we're supposed to refer to you as?
Yeah, that's good enough. I mean, there's other adjectives and ad hominems you could probably use, but officially, yes, I guess that's my title.
Can we just call you King Fed?
No, God, no! Please don't. I forget who I was talking to, and maybe it was with Emil, and they always say, if you were the Fed chair, what would you do? I'd say immediately I would hang up the phone and go hide in an island somewhere. I'm going to go join Emil in the Caymans or something.
Like I would go and hire a Fed chair. Okay, and Emil, what's going on, man?
I just finished reading. For this show that I do reading around macro, where I read somebody's interesting analysis, very often Jeff, but I did something about geopolitics by George Friedman. I did a piece by Daniel Oliver from Merriman King Capital about real rates and gold. And I just finished reading out loud Jeff's presentation to George Gammon in June. I think it was June, Jeff. And it was all about crypto, ghost money, ledgers, and the great bullion famine and the great eurodollar famine. And it was fantastic, Jeff. Fantastic. I can't wait to post it. And it dovetails so perfectly in what we want to talk about today.
We don't mention George Gammon's name here because his secretary put me off 17 times for an interview. George does not exist to me. You are dead to me, George. Just kidding. I like George. No. George is awesome. Okay. Let's go to our non-commercial break with zero sponsorship activity, and then we will be right back. And let's get into the guts of what now. I think that's the good theme for today, like what now? We will be right back. All right, boys, before we get into the guts, I do want to thank, we have a new partner that we are now streaming to trading.tv. So it's a really cool platform where they're integrating exchange functionality, both for equities, digital assets, and even some other more kind of erudite financial products into live content, which is really cool because it lets people, well, we'll see if it's cool, but it lets people act on information in a hopefully a more seamless way. You hear a research project, you want to go dig into it, you want to look at price information, all that kind of cool stuff. They have a lot of other stuff. I'm certainly not doing them a service, but it should be interesting to see how that idea of an amalgamation of real-time trading and investment and information and live streaming all kind of melt together. So kind of cool. All right. So Jeff and Emil, I just got through. First of all, I listened to all your videos, and this week I got served them. I was telling Emil kind of in reverse order. And I kept coming back to, especially when you were talking about the vicious cycle and the virtuous cycle, which is, could you give us a quick breakdown of that, Jeff? And also, Emil, what pushed you guys? That's a very interesting cycle that I think maybe people should have been taught this, like May of last year. So that looking forward, a lot of these kind of supply and demand snafus would make more sense. So I guess my first question is, Emil, how did you guys choose that subject? I'm always curious how you guys pick what you're going to do on Making Sense, which is probably the best show on YouTube.
It's always Emil.
We have hired porpoises, manatees. Now, if I remember, it was from South Park. Did you ever see this episode, Nick? They wanted to know how Family Guy comes up with their ideas. And what they did is they had a bunch of rubber balls with topics that they threw into a pool. And the manatees kind of just randomly picked them out. And that's how Family Guy would come up with their shows. I use the exact same process. The manatees are very cheap. I pay them well below market rates. And also I add a little bit of context. I say, like, what haven't we covered recently? So Jeff will write about bank reserves, and I'll say, maybe we've covered that on the last show, the show before that, the one before that, and the one before that. But we
the 5 dozen before that.
Yeah.
So Jeff, so does that mean, Jeff, that the manatee pay has exceeded the market clearing wage? Is that?
Yeah, we do pay our animals market clearing wages because it's the only fair way to operate any business on a micro scale as well as a macro scale. The one exception is, unfortunately, Emil's assistant, who largely does most of the work, but gets none of the credit.
We call that a co-producer. So, okay, so on a more interesting note, or maybe not more interesting, just more serious, Jeff, the vicious cycle and the virtuous cycle, how could you explain that to simpletons like myself and people that might not understand that this is a normal system in the kind of production path?
It used to be the entire basis behind recession. The 20th century was marked by recessions, which were largely due to the inventory cycle alone, or at least, the basis of the recession or the business cycle had to do with inventory. What that really is that, look, businesses, we can't match perfectly end user demand with production. And so there has to be some level of, sort of a margin of safety of production of goods and the availability of goods throughout the supply chain. And that causes problems, right? If you're a retailer, you have to have some inventory ahead of time. Otherwise, you might get caught without the ability to service your customers. If suddenly demand goes soft, you're left with more inventory. Plus, you've got more inventory coming your way from the wholesalers who are buying it from producers. So you kind of have a really bad situation potentially, where if you think that demand is going to stay soft, not only do you have excess inventory now, again, you've got more inventory coming up the supply chain in your direction. So you have to make a judgment. Is this a soft patch? Is this some temporary problem? Do you think things will turn around? And if you start to believe that this softening in demand is maybe going to stick around a while, you have to start cutting back that inventory that's flowing up into your direction because you already have too much at your stores. It's expensive. It's cash intensive to hold inventory. So you call up your wholesaler and say, hey, slow down the inventory coming up in my direction. I can't sell it as fast as I used to. And then the wholesaler has to make a judgment. If you're not the only one calling the wholesaler telling him to hold up, if he gets calls from all sorts of retailers, the wholesaler is probably going to call the factory or the factory in China and say, look, we're getting full of inventory here. We need to cut back on production. And so that's sort of the beginning of the vicious cycle where inventory starts to clog all of these supply channel levels. And it can lead to a situation where, retailers not just cutting back on inventory, maybe they're cutting back on hours worked. Wholesalers do the same thing. Producers do the same thing. And next thing you know, maybe that creates even less demand because workers are consumers, which, kicks off the real vicious cycle, which if it gets far enough leads to a situation where we're not just scaling back hours at retailers or in the factories, we're actually laying off workers, which is where this vicious cycle becomes the actual business cycle in the form of recession.
So let me ask you this. So I see this as two, kind of the yin and yang, two halves of a big circle where half of it is virtuous and it must necessarily lead into the vicious side. You kind of can't have a perpetual virtuous line, right, without money from somewhere. And money from somewhere is usually not real money, right? So could it be that, or is this a fair way to look at it, that during the end of the virtuous cycle, as it goes into the vicious cycle, is when things like the necessity or the anomaly of a eurodollar situation or if the ancillary could be cryptocurrency as solving a need as like a liquidity crunch. Is that like the fertile environment for kind of originating currency units out of thin air?
Well, it can be. And the inventory cycle is one part of a much larger, more complex system. And so there's all sorts of ancillary factors that contribute to it, or feedback mechanisms that make it bigger, or actually, a negative feedback loop where it exhausts itself before it becomes too much of a thing. You think about a credit-fueled demand boom, that's going to have a much larger, vicious cycle to it, because once the credit dries up, then it's not just about the inventory cycle, it's also about the lack of credit flowing through the economy. So the inventory cycle is actually amplified by a credit cycle. And so if those things all sync together, that's where you really have to watch out. But you're right, Nick, there is a yin and yang to it. And even in the business cycle itself, the other side of it is inventory restocking, which contributes to the virtuous circle of recovery. Because businesses, after having been depleted of inventory during the contraction, during the recession, at some point they think, well, that's, business is starting to bottom out, maybe even ticking up. I'm not just going to order goods that I need to sell at this low level. I'm going to start ordering so I can get my inventory back up. I'm going to start restocking supplies and things. And that creates an additional layer of demand on top of, gently recovering demand that creates the virtuous cycle, because then the producers have to hire back more workers, and that raises demand even more. And so you have the other side of the business cycle, which is recovery, largely predicated on this industrial restocking inventory.
So, Emil, go ahead. Can I just real quick ask you, Emil, when you're looking at this in terms of where the eurodollar crises were, and you guys have them pegged to like exactly when they started, do you see that there's kind of a common thread where, like, okay, we're in, the first quarter of, say, the vicious cycle, we see doom coming. This usually is the predecessor, but, this foretells of another eurodollar quagmire?
I don't think so. I think what we're experiencing right now, this inventory cycle, is a little bit different than what we've seen before, except maybe after 2008. And what I think the point of our show was that we're seeing heavy restocking, which would suggest, great, this is good news. We're bullish on the future because we're assuming the demand will be there. But in the show, what we talked about was that maybe this restocking is happening due to supply constraints. The producers, the wholesalers, the retailers want to have any product, a product, whatever, on their shelves, because they see what's happening around the world with the shortages, the supply chain snafus, the logistical snarls. So they're saying, let's order anything, everything. And so we see a surge in orders, which normally you would say, okay, good, the economy's coming back. All these guys believe in it. And if the demand will be there next year, then okay, great. But maybe they're not doing it because they believe in demand, but because they're so worried about the supply chains being broken. And they just want to have anything that they can sell.
Isn't so Jeff, in a situation like this where we may be getting bad information and the suppliers may be restocking on this assumption that there's an overall growth and an expansion in the economy, when that my contention is things have been bad pre-COVID, they're still bad, and people are just mostly on the aggregate looking at bad info, except apparently the bond market does suss this out. What's going on? Like, do you see indicators that the bond market agrees or disagrees with the theory that everything's great?
Well, Nick, I think I'm gonna have to disagree with your characterization. Is there such a thing as bad info? There's only information, right? I mean, there's difficulties in interpreting good information. That's human nature, right? We're not perfect. We try to deal, and these are very complex systems. Something Emil talked about recently. It's very difficult to say this is exactly what's happening today, and X happens today, Y follows tomorrow. It's really that easy. And so, yeah, we have all of this conflicting information. I think a lot of it is conflicting, and so maybe that's what you're talking about with bad information. It's not so straightforward as maybe it should be. Like we should be able to see that, yes, this is an inventory restocking phenomena consistent with recovery and inflation, and things are going in the right direction. But instead, we get all these contrary signals that say, wait a minute, inventory is being restocked, or at least it's attempted being restocked, and it seems to be a little bit of a bubbly type behavior in the industrial part of some parts of the global economy. But yet there's all this other pessimism in money and markets that says, nah, there's something that's just wrong here. There's something that's off here. And so we're not getting a consistent interpretation of, say, economic data with market data. And it's how do we reconcile these differences in a way that actually makes sense? And that's really kind of what Emil and I wanted to talk about on the episode was, okay, let's look at the inventory data, the non-auto inventory data, because obviously with the automobile sector, the inventory is on the exact opposite side of the spectrum, which I think is clouding a lot of people's judgment too. Again, it's not bad data. It's how do we interpret the data? And most automobile dealers in the United States and around the rest of the world, their inventories are ridiculously low and they can't get any stock because it's very hard to produce automobiles at this particular moment in time for several reasons. But on the outside of the automobile industry, inventory is kind of on the other side of the spectrum where it's getting to the point where, as Emil said, retailers in particular, they've come out and said, we have intentionally over-ordered because we're just trying to stuff as much product through the supply chain, hoping a little bit trickles out. And they realize that at some point, these supply snafus, these logistical problems are going to work themselves out. And at that point, there should be a flood of inventory as everything that they've over-ordered gets delivered. And what a lot of them have said is, look, we're okay with that. We're prepared for it. We've hired extra warehouse workers, we've rented extra warehouses. We've got logistical supply firms and all these kinds of things advising us. We think it won't be a problem. But if there's anything that we learn about it during abnormal periods like this, or in any eurodollar period since 2008, it's that corporations do a horrible job of managing their expectations. And that if this inventory problem doesn't, when it actually does start to get worked out and the inventory does start to get delivered, if there is more than just Q3 Delta COVID softness going on in the global economy, what really does happen? Do we actually get back into a really 20th century style inventory vicious cycle where it's more inventory than anybody was expecting, and it certainly doesn't keep up with demand? And so I think your question, Nick, is, after we reconcile those possibilities, is that what we're actually seeing right now? Are we seeing the beginning stages of maybe the inventory vicious cycle beginning to show up on just the edges of everybody's radar screen? And that's, I think it's too early to say, but there are certainly the indications where we're looking at certain things, whether it's real economic data or market data, where it says, yeah, there's some softening going on here. It's been blamed on Delta COVID. But there's some other things like, the big French freightliner firm that we talked about before, who said we're freezing all of our freight shipping rates from now until February next year, which is one of those things that doesn't make sense in the context of inflation and logistical problems. So maybe we are starting to see that this is more than just Q3 Delta COVID, maybe softening in demand, and we'll see what happens with inventory.
Because when you guys were talking about that, the French shipping line freezing their rates and things like that, I instantly kind of thought back to Jeff Booth, and I'm like, well, that looks a lot like deflationary forces at work. And then you start to go, well, then that starts to look a lot less like a bright, free-flowing credit and cash economy of expansion, and a lot more like an area where logistics have gotten so good. I had a buddy who manages a pretty fair amount of money, and he's old school, Brooklyn, been in the bond market for 35 years. And he said, we'll never have those gas line, the lines at the gas station like we did before, because we've worked that out. He goes, and that's the good side of deflation. He goes, but the bad side is what you'll see everywhere else where people don't have jobs. And so I try to always go, are we in a faux expansionary economy that's just a reciprocal of not bad information, like you said, but a misunderstanding or a misweighting of the information, and thinking you're seeing something different than what may actually be if you kind of spread it all out on a chart?
Yeah, but it's not just this too. I mean, think about market prices. Stocks, of course, a lot of people pay attention to the stock market, even though it only goes up, it never goes down. But also commodities. I mean, commodities have been screaming that something's going on here. Again, it's not bad information, and I'm gonna keep hitting you over that for the rest of the show.
I will never say that word again.
No, but the point was actually a really good one, which is that it's difficult interpretation of actual data. And so you look at commodity prices and you think, well, everybody's been screaming for forever about the Federal Reserve printing money, destroying the dollar, and commodities are where you would go as an investor to protect yourself from devaluation and inflationary currency. So the fact that commodities screamed higher late last year, early this year, kind of made it sound like, again, not bad data, but difficult interpretation. Maybe this is all really an inflationary recovery because the price of copper, the price of lumber, price of iron, whatever you want to pick, seem to just be going parabolic at that point. And it sounds like, here we have 5% CPI. So it must be not just a recovery, but a real inflationary type situation, because it does seem like all of these things are happening. And so if you have no other data or you're not looking anywhere else, it's very difficult to say it's something else must be going on here, except you don't have, it's not like we have a dearth of data on the other side. It's like the entire bond market throughout the rest of the world is saying, no, this is not going on. And it's not like the bond market is some small, out of the way niche thing that, it's easy to dismiss and deny or just ignore. So when you put all of these things together, yes, there are contradictions, which means you have to readjust your theory of what's going on to fit all of the facts, not just some of the facts, but all of the facts.
Now, Emil, you're in the commodity space, specifically precious metals. What are you seeing kind of from the ground level?
I mean, from like supply and demand of the different commodities?
Yeah, like on actually at the metals level. Are you seeing the kinds of things that look like an expansionary economy, or are you seeing things that look like, log jams and logistics? What are you seeing?
I see the latter. I don't see an expansionary economy. That would be surprising. I think we are in perhaps the third reopening boom, the third survivor's euphoria since the COVIDs came. With the first one, say, in May of 2020, and then the next one after the vaccines were announced. And after each of those first two, we had something in the monetary world that kind of said, I don't think this is going to be a full-throated recovery, a rip-roaring A-OK to turn off the economy and turn it right back on like nothing's ever going to happen. And so I think that's what we're going to see after this third sort of peak in the Delta COVID's case count that kind of happened towards the end of August. I think that's where we are right now. Things are looking better relative to where we were in the summer. How long that lasts, I would think, I don't know, a couple of months, some period of time before the underlying reality is shown as being not conducive to further economic growth. And we can look to eurodollar futures and bond markets on a relative basis. I know that U.S. Treasury yields and other sovereign bond yields are up right now. They're up. But as Jeff's writing often shows, he has lots of graphs in all his blog posts at Alhambra Investments. And in there, he often shows a comparison of the three previous global dollar squeezes that have happened since 2007 to this one, this being the fourth one. And he compares how the bond market yields reacted during the reflations. And you can see the other reflations were, we're going to do it. We're going to take off to varying effects. This one's been the most muted by far. So even though we have bond yields rising, so bond prices are falling, and it suggests that maybe there's a recovery ahead, you've got to see it keep going and accelerating. We need a true bond rout to signal to us, hey, the economy is going to recover. And then also when it comes to commodities, China, what's happening in China right now, and the news in China has been mostly negative, right? You've got power supply cuts, you've got a debt, towering debt bubble. It's always there. And then Evergrande, how is that going to resolve itself? So it's a little bit, that doesn't inspire confidence for a real recovery, which would be based on real global monetary expansion.
Yeah, and going further with China, I think China is the real story here, especially as it is not just commodities, but the entire global reflationary trade. it's largely dependent upon a resurgence, or at least the expectation of a somewhat resurgent China. Maybe not in the way that was in 2010, for example, but certainly better than it had been in 2018 and 2019. That's been the persistent, whether it's mainstream economic forecasts or whatever. And yet all we hear from China is this problem, that problem, the other problem, which when you actually look at them, again, interpret the data, the information, it's consistent with the idea that Chinese have long ago thrown in the towel on their capitalism phase. They are transitioning in a very determined, deliberate pace into a more socialist structure, which means we're not just talking about growth in 2021 and potential 2022. This is long-term structural stuff. And when you pair that with what's going on in commodity markets, as Emil was saying, you get more of these supply logistical problems in commodities than you do any, super cycle that's coming up in commodity prices. It's really a temporary, transitory thing, because underlying the global economy, you have this, ever-present dollar problem, which is one of the reasons why the Chinese have said we're throwing the towel in on our capitalism phase, because there is no global growth potential here. And now is the time, according to Leninist Maoist doctrine, that we start carving everything up. When you look at China in that way, everything they've done this year makes perfect sense. They're moving toward carving up first the excesses from the capitalism phase, and then moving, after they do that, they're going to further reorient the Chinese economy in a more socialist, a lack of hierarchical structure, which means lack of economic growth coming out of China too.
Does that basically put every other country on the back foot? I mean, how many countries do you think are so reliant on the machine that is China, even if they don't like to admit it?
Well, look, if you look around at the economic data, just right now across much of the world, it does not look like the United States. The United States is the clear outlier. And really, the United States data doesn't look all that great either. It just looked better than everybody else, and it certainly looked better than it did last year. But you're right, to your point, the Chinese economy hasn't really recovered from 2020 recession, and consequently, much of the rest of the world looks really ugly. It doesn't look like it's recovering. And the reason, again, going back to prices and interpreting data, the only reason prices could have gotten so far out of line is, number one, you have all of these logistical problems that created nightmares. And, going back to what you said before, Nick, about the supply chain, they had, for years and decades, it had been a sort of a taken on faith, or taken for granted, that just-in-time inventory, which meant there's no room for error, would be able to manage, even large crises, like something like 2008, for example. But nobody ever foresaw something like the overreaction to COVID pandemic, shutting everything down and being very difficult to restart everything. And once you have these supply chain issues that are basically, they're based upon everything moving in concert with one another, and then suddenly you stop one part of it, it just backs up in a way that it's not so easy to just flip out a switch on and flip a switch off and flip it back on again. So there are very serious problems, because our modern supply chain was never meant for this kind of a situation. And that was further, the imbalance was further driven by, of course, Uncle Sam's helicopters late last year, early this year, which then boosted demand artificially all at the same time. At the very same time, some of these logistical nightmares were at their most nightmarish. So we have this combination of factors, but when you step back from them and try to interpret that not just in terms of bond yield, but all economic data across the rest of the world, you look at the rest of the global economy, and it is seriously ugly. These economies are our neighbors to the south, for example, Mexico. You would think that, being our neighbor with the U.S. goods economy going into overdrive, that Mexico is flourishing from that. They're not. The Mexican industrial economy, industrial production, for example, is significantly below where it was last year, which was significantly below where it was 3 years ago. So the rest of the actual global economy is really nothing like what it is in the goods economy in the United States.
Do we have a situation where I picture it like this old woman, say my grandmother, and she has circulation problems right now, and those are all these little kind of log jams and snafus and logistics that are a result of, let's say, the COVID shock or overreaction and underreaction in some places over another. So you have grandma, and she's not feeling well, and we're just forcing her onto a running machine and turning it at 10 and saying, good luck. And obviously that's not what she needs right now. And I look at that as kind of the overall And there's still these embolisms and these vacuums in her, circulatory system that haven't been worked out yet. And so there's a lot of what I think is flawed decision making on misinterpreted data, and it's happening all throughout the system. And the problem is it's very tough to get everybody back into some synergistic, global system of trade and commerce. Is that kind of a way you could look at it if you use my grandmother?
I think that's a great analogy. I often with Jeff, I always talk about globalization, and that the thing that floats globalization is the expansion of money from advanced economy money centers, which in your case we could use as the analogy of blood, helping the system function, the global body economic, for it to be able to run on 10 or even if 11 on the dial. But because the blood's not getting everywhere, you're struggling, especially after 14 years, where you just don't have enough energy reaching your muscle groups to keep it going. I wonder what the solution is. I don't know what the solution is. I guess previously what happens is it just has to break down to a lower complexity, a lower state, maybe nation states, and then individual nation states kind of function, fix themselves internally. And then maybe they create alliances or partnerships with neighbors, and then that grows from there. The network rebuilds itself that way. But trying to turn back on the network as it had grown up to 2008, the post-Cold War globalization, trying to get back to that, it's just not going to happen. We have to start and create a new system. And I think, unfortunately, we have to go back further first. Worry about the United States or Britain or Spain, and then expand from there.
Jeff, is this Yellenism? I mean, is this the idea that central planners, and I know we don't have any here in the United States, but in other places where they do have somewhat central banks and central planners that centrally plan from the front, is this the problem that they now believe that they can manage economies, paper over recessions, and we'll never have a recession again, or we can just throw quasi money at any problem and no more recessions, everyone? Is that kind of this belief among central planners right now?
Actually, I think it's the opposite. And the belief that you're talking about, we used to have a name, is called filling in the troughs without shaving off the peaks. And it was something that this expectations-based central management or central bank policy that came about in the 1980s led to this belief that we could a functioning technocratic central bank using expectations policy could void the entire business cycle entirely. That was in the late 1980s, early 1990s. Then throughout the quote unquote great moderation, it came to be believed that yes, Alan Greenspan, through his beautiful manipulation of federal funds that is largely irrelevant and worthless, had managed to, it's not maybe completely abolish the business cycle, because there was that little dot-com recession in 2001, but had made recessions so mild that we barely even noticed that they'd happened. So maybe they didn't get rid of the entire business cycle, but they had shoved them down to so small that it didn't even matter. And of course, that theory was completely, utterly obliterated in 2007 and 2008, when what happened wasn't even a recession. It was actually the beginning of a depression, which in some places throughout the academic economic community, they realize that that's the case. So they're no longer thinking that we can abolish the business cycle. They're more thinking about how do we cover our ass and make sure that nobody blames us for what actually happened in 2008, which is somewhat along the lines of, okay, we're going to not really talk much about the business cycle anymore and make it sound like we're not in control of any of these things. We're sort of just bystanders. And, if a recession shows up or an exogenous shock, such as March of 2020, it's not our job to prevent it. It's our job to clean up after it. That's this market of last resort nonsense, where central banks basically say, something bad's going to happen. We can't really avoid it. We're just going to try to make sure it doesn't get as bad as it maybe. It could get worse if we don't do anything. So that's really how economic theory has evolved, especially since 2008, not just in the central bank context, but overall in economics, where the business cycle, we used to think we control the business cycle, and we had almost abolished it. Now it's like, history has shown we didn't do such a good job there, so we got to do something else entirely. We have to think about it in an entirely different way.
Do you think that there is this kind of underlying assumption now among planners and the like and their ilk that everybody is too big to fail? That there is, it used to be, well, it's big banks and, these, what do they call them? Fallen eagles or some ridiculous term or things like, we can't let them, is there just, yeah, I mean, when a company that was incredibly important to the United States, to the welfare of the people, would fall into, below, triple B and become junk or something like that. Is there this assumption now that just basically anybody is too big to fail, and so we should just bail out? Because I feel like every awful business is supported these days. No one's allowed to go bankrupt in the same way that we're not allowed to really have a recession. And it just feels like if you don't let anyone fail, this is so far from an efficient system. Am I looking at it wrong?
It seems that way, doesn't it, Jeff? Because the economy is not a free market, or not even what it once was.
Not
so it's
capital.
malfunctioning. It's struggling. And therefore, it's very easy to say this economy stinks. It's not working properly. How could we, in good conscience, allow creative destruction, right? How could we allow the airlines to go bankrupt during when COVID first struck, or the cruise ships? We can't let that happen. Back in the 90s, somebody would have bought them up, fixed it, everything. It could feel like you could let it happen, right? But now the economy is not working. So no, you can't let someone come in and fix things, because you don't know if it would be fixed. You would just have a surge in unemployment. I think we first saw it in 2008 when the car companies, remember, they were heading into bankruptcy, but then the government swooped in to save them from bankruptcy and intervened in what should be a private market affair. And we've just continued that policy ever since. And of course, it's building inefficiency on top of inefficiency. It's this self-reinforcing spiral. When we look at this monstrosity, say, well, we can't trust the market to fix it. But you know what? We're just in that
Emil,
era.
It's the ratchet effect, right? It's that when things start to go bad, we start to take a harder look at the things that go wrong, because we identify things that go wrong with the badness, right? And so as that doesn't help, then more things go wrong, and we pay more attention to those things, and then we tell ourselves that we have to not let anything go wrong. Whereas in a healthy, functioning economy, we don't notice the things that go wrong, because that's part of a healthy, functioning economy. It's really the fact that the economy isn't healthy that we spend more and more attention on these things that could potentially go wrong. And then we convince ourselves that we can't let anything go wrong, because the situation has become just so fragile that even the smallest little bit of something going wrong will upset the apple cart and things will get even worse. It's part and parcel of human nature, as well as this is kind of how complex systems reduce themselves as well. But there's another part of this too. Nick, you talked about failure too big to fail. That's only the stuff that we can see. The things that trade on a market, for example, or junk bonds in 2020. There's a whole other part of the financial monetary system that we don't see, that has not just failed, it continuously fails, and nobody cares about it. And that's really what lending, pure lending, loans from the banking system used to be. That was the point of lending, was that intermediating between monetary resources and financial resources and economic needs, not just because Google or Apple wants to buy back shares, so we're gonna lend to Google and Apple, but we're going to lend money to mom and pop because they represent a legitimate business opportunity. And so that kind of illiquid situation in the eurodollar system of 2007 has essentially robbed not just the U.S. economy, but the global economy of its lending capacities, and therefore its intermediation capacities. So while we're so focused on the junk bond market maybe we can't allow any failures in the junk bond market, this entire part of the global economy has been left to fail for more than 14 years now. And we don't recognize it, because none of that stuff ever trades on a market. And we've been conditioned to believe that if it doesn't trade on a market, it doesn't exist. And that's part of what we do a lot of, is try to identify and highlight the fact that we're leaving a huge part of the global economic marketplace out of our, again, it's not bad information. It's misinterpreting what's really going on. And so the too big to fail really has only applied to a smaller, narrower segment, when the actual failure has actually happened for a prolonged period throughout a big part of what used to be counted on for global economic growth and acceleration and contributing to social advancement.
So, so that kind of dovetails with kind of where I want to go next, which is, okay, money creation. So, which has led to a lot of these problems, or a lack of money creation. There was something you said a few weeks ago, you and Emil were talking, and you had basically said that when the broker dealers step back, then economies basically, they become anemic. They start to, to me, they are the first, and they're the real central planners, aren't they? Because where is money created? Through debt destruction, through some kind of inefficient transfer payments occasionally, and through lending into society with the idea that banks would let these mom and pop businesses go forward with their ideas and the kind of the American dream. But when the broker dealers, when the big boys step back and that lending stops, aren't they really kind of the first and last everything?
Yes, but it's not central planning. This is just pure intermediation. And where the eurodollar system took it wrong step was that it combined money creation with intermediation. So the people who were doing the intermediation, these large global banks, were the same ones who had the ability to create the money, which is always a bad idea, because eventually that gets bastardized and whatever. And if you're allowed to create the money, you're no longer serving the vital commercial interests of the global economy. You just start inventing clients, right? Because you're the ones creating the money. If you can create money, then you can create your own business. Then you're no longer intermediating. But that's not really central planning. That was just a stupid mistake of, a ad hoc system as it grew together. On the other side of that, it's not central planning either that banks step away when they feel risk averse. It's, again, the lack of intermediation function, which is such a crucial part of any functioning monetary system and functioning economy. Is you have to have money and you have to have intermediation, which is simply how do you match supply with money with the demand for it? And that's what the intermediation function is. And what we were really saying here is that we have, because the eurodollar system combined money creation, intermediation into the same sort of entities inside the system. Not only is the money creation function broken and malfunctioning since 2007, thus so must be the intermediation function. And part of that broken intermediation function is what I just said, which means we don't get lending to the smaller businesses that don't float junk bonds on some sort of syndicated exchange, right? So the intermediation function is really what's missing here. And usually because of that, in the situations like that, economic growth that tends to be less than ideal, less than satisfactory, that's when you see all of the central planners sort of swoop in and try to fix the situation, except, again, bad information or lack of ability to interpret information. They only do the wrong types of steps to try to get the economy back on track because they don't really know what's wrong, or they're forced into believing by economics that this is a recession. And so we just do what we normally do in a recession, which is boost aggregate demand, which is exactly what happened earlier this year and later last year, is that governments did the neo-Keynesian thing, which was to boost aggregate demand through government's fiscal channels. But if you step back and say, well, look, this is not a typical recession, we have an impairment in the banking system, which means money and intermediation, then everything looks very differently. And then you don't just throw money at the problem or try to throw Uncle Sam's borrowed money at the problem. You have to do something very different, which is let's look at the money and intermediation system and figure out how do we fix this, which is a very, very different set of circumstances.
So I guess you really can't print prosperity. I guess you can print the word prosperity. You can print it and press dockets, things like that. But you can't print actual prosperity, and you especially can't print it with Groupon tickets. So let me ask you this: for a lot of people, they listen to your show, and I first of all, if anybody that's not listening to Making Sense, Eurodollar University, and reading your articles, Jeff does. I don't know how you ever sleep, because it seems like you write all the time, and when you're not writing, you and Emil are talking. But I'm sure at some point you sleep. And one of the things that I think I get asked, let's say, like, what is the eurodollar system exactly? Could you explain it to a bunch of rubes like myself? If you had 15 seconds in an elevator to explain to Jerome Powell the thing he apparently is missing and has missed his entire career, what is the eurodollar system, Emil?
No, I'm gonna ask Jeff to do it, but I want Jeff to bring in the Great Bullion Famine and the Eurodollar famine. So, I mean, kind of like it's there, Jeff. It's like we've been here before. This has happened before. Humans have created the Eurodollar system before. We've been confronted with money shortages before. And this is just the most recent edition of it.
Well, to take your first question, Nick, what is the Eurodollar system? To put it really briefly, not get into all its various complications and formats. Essentially, what is actually money in this system? It's not physical Federal Reserve notes. It's not bullion. It's something else. It's bank liabilities. And what do we mean by bank liabilities? And it's simply, Emil and I are two financial entities who want to do some business together in a paper-based system, or I think the monetary system most people have in mind when they think of a currency system. If Emil wants to borrow cash from me, I will have to send him an envelope full of physical Federal Reserve notes, right? And so that we'll have a relationship where I have given him something physical and tangible, which is Federal Reserve notes. And therefore, those Federal Reserve notes are the medium that intermediates between what we're doing. What the Eurodollar system did was essentially say, no, we don't want to wait for cash to be transported across oceans. We want to be able to pick up the phone and instantaneously undertake these kind of financial and monetary transactions. So Emil and I will do the same type of lending arrangement, except I won't send him a package of actual physical Federal Reserve notes. I'll just get out my ledger and write down, Emil owes me $5. And Emil will get out his ledger and says, yes, I owe Jeff $5. That's essentially the Eurodollar system. It's a system of ledgers where the banks that operate in this ledger system simply say, I owe you this amount of money, you owe me this amount of money. And we never actually settle for physical currency because we don't need to. It's just, Emil wants to repay me some of money. We get out our ledgers, we tick off numbers. It's all just a system of bank liabilities and bank assets that get traded all over the world by this Eurodollar banking cohort, which, so long as everybody agrees at the end of the day, your number matches my number, however that transaction is structured, that's the essence of this virtual ledger money system.
Mute. You hit mute.
I unmute. Can Bank B in this situation, can Emil take that $5 IOU and go and purchase, let's say, property in the United States with it?
Absolutely. They can also lend it to somebody else. And it's not just, these dollars that, we talk about all the time. We're also lending financial securities. We're lending collateral. We're lending anything. We're structuring derivatives trades. So a derivative, a currency swap, for example, isn't just lending cash today. It's lending cash in the future, depending upon, modeled versions of cash flows coming back. It's essentially an entirely fungible system of virtual ledger currency, which is the reason why, as Emil was trying to get me to talk about, it had solved essentially, which was Triffin's paradox in the 40s and 50s, which was a restriction on monetary growth for a globalizing economy. Essentially, there was not enough. Well, there was enough gold, but it wasn't distributed widely enough that it created these monetary bottlenecks, which, if they had been allowed to be the end of the story, then we never would have had a globalized economy to begin with. So it was a real impediment to economic growth in the 40s and 50s. When banks and operating in this Eurodollar market, as it grew up out of, however it did, they decided, well, we'll just do this ledger money system, because then we don't need to settle in gold. We don't need to settle in physical Federal Reserve notes. We just need to settle between banks operating in the system. And we just settle based on, because of innovation in communications technology, we can just pick up the phone and talk to each other and settle virtually across even a computer network, as became the case. So the ledger money of the Eurodollar system solved a tight money Triffin's paradox, which, the gold exchange under Bretton Woods, which is another historical example of what commercial and bank and monetary agents will do when confronted with a structural systemic monetary shortage. They'll make do. They'll figure out other ways to do this. And a ledger money, in many ways, is an elegant solution to that problem, because it's really kind of simple. So long as we're operating on the same ledger and doing basically the same things, you don't really need another medium of exchange in between what we're doing, because the ledger itself becomes that medium of exchange.
So does cryptocurrency, in a sense, look like another iteration of the Eurodollar system?
It is exactly the same in its base. Stepping back in its, in its generic characteristics, it's pretty much exactly the same. Because what is cryptocurrency except a decentralized ledger, which is really what the eurodollar system was a decentralized ledger, but it wasn't widely decentralized. It was decentralized among the banking system. So I say all the time, I can't just go to the Cayman Islands with Emil and say we're a eurodollar bank. So let's start lending and buying money. We have to take some steps to become part of the club. If I go to the Cayman Islands and I fill out all the paperwork and I say I have a $2 million credit letter of credit from Goldman Sachs, suddenly I am a eurodollar bank, and then I've been admitted to the club, and now I'm part of that ledger system as long as I operate within that ledger system's rules. So crypto is it's pretty much the same thing, where the ledger isn't narrow. It's more widely distributed, more decentralized. And I think what makes it even more superior is the fact that it's more transparent. We don't have to wonder what all these eurodollar banks are doing with their ledger because they're the secret gatekeepers to the ledger. We can see it on blockchain everywhere. Everybody can see it.
Do you think, and again, we're just kind of throwing stuff out here, and Emil, I want you to weigh in on this. Does it look like to you guys as you look at the crypto space? Because I know for you guys, you obviously, Jeff, you've been around crypto since 2013. You've been talking about it and writing articles. People think you're new to this. You're earlier than most people that are in the crypto space, like even as investors and designers. But do you and Emil, do you guys see that this is an extension of the eurodollar system because people were worried about this kind of nebulous, dark, murky, shadowy banking system? Or is it another forced situation where necessity breeds invention? There still was a lack of liquidity. There still was a lack of cash availability. And here comes crypto. And this was a disintermediated way to launch another set of less murky, shadowy banking financial products.
The latter. And I encourage everybody to go to the Google machine and type in Jeff Snider ghost money or Jeff Snider, the Great Bullion Famine, and read the articles, videos that come up, and that sets the scene. I absolutely encourage that. It'll do a better job than I can possibly explain. We call it the shadow system and the murky system, and it sounds nefarious, but it's the shadow system because it's offshore, off balance sheet, and off the regulatory radar. It's hard to see. It's not necessarily shadows as in spooks and bad guys, that sort of thing. We had confidence in the shadow money system, a lot of confidence, so much confidence that we relied on it for decades to fund the global economy, even though it was hard to understand what in the world was going on. When it malfunctioned is when Bitcoin first came into being, right? And ever since then, more cryptocurrencies looking for a solution because it malfunctioned. The liquidity of this shadow system that we don't understand, but yet we had confidence in it for decades, is not working. I'm pretty sure that we would not have gotten as far as we have in cryptocurrency here 14, 15 years later. No, that's wrong. 13, 12, 10, 11, 9. Between 1 and 50.
One of those numbers.
If it wasn't for the fact that the spooky, creepy, undetermined shadow system has malfunctioned and credit is not being redistributed and created liberally.
Now, I think, Nick, you made a really good point there, which is that's what's really driving. What Emil just said is what's driving cryptocurrencies. That the eurodollar malfunction has opened the door for competing currency, and it's not surprising that it took the ledger format because that's historically speaking what always happens in these periods. But the specific, I think, the ethos behind a lot of digital currencies, Bitcoin in particular, took itself from that what we just talked about, how the eurodollar system was so highly opaque. So the point is almost impenetrable, and people just kind of threw up their hands, especially after what happened in late 2008, and said, look, there's got to be a better way of doing this. It can't be this complicated, opaque system that nobody has any idea what's going on, that, oh, by the way, this opaqueness actually privileges all these large banks because they get special privileges for creating money, as the Austrians say, Cantillon effects. There has to be a better way that we can do this. So The eurodollar malfunction opened the door for cryptocurrency, the need for elasticity in currency in some other format. But the way in which the eurodollar functioned in this sort of black box model that nobody else is privy to, including central bankers, they don't tell you that part, but that black box model, people kind of recoiled at that and said, look, we need a much more transparent system because we don't even know what's wrong. We can't identify anything that's wrong. We know a lot is wrong. We don't know exactly what it is because we're not privy to what's going on in this ledger. And so the format of the eurodollar system, I think, highly influenced, in fact, directly influenced Bitcoin, but it has highly influenced a lot of digital currencies to say, we're going to do it the opposite way. We're going to decentralize. We're going to open up everything. Blockchain is going to be as transparent as it possibly can be because we've seen this eurodollar system. And when it malfunctions, if you can't put your finger on what's going wrong, that opens up, just more problems on top of more problems on top of more problems. And by the way, this fact that, we're privileging the holders of the ledgers, that creates problems too, not just rent-seeking behavior, but also all sorts of unjust political privileges as well, right? I mean, that's really where too big to fail came from, was the idea that these banks who keep the ledger, we have to keep them in business, otherwise the ledger goes kaput. So we don't want to do that either. And that's really, I think these two things are what's driving the technology and the innovations behind the crypto infrastructure and the designs.
So let's reduce this back. Let's go kind of up to the clouds and look down on the human earth creatures. As kind of a closing thought, Emil, start with you. Where are we right now in the global economy, and what does the next 6 months look like to you?
I think it'll be a two-phase step. The next couple of months will be of reflation, exploring the possibilities of upside. The Delta COVIDs have passed. Maybe it's going to get better. It's certainly going to get better than this summer. So let's explore that. Let's see what happens. And that's what will be, markets and the economy will be looking forward towards in the next couple of months or so. But then I figure the second half will be right back to a downturn because the underlying economy's health is weak. And what would be disconfirming is if I saw bond yields rally, bond prices fall tremendously. Sovereign bonds, as well as eurodollar futures, the yields to expand, as well as some of the other monetary measures that we keep discussing on our show. So that's what I see the next 6 months is kind of a two-step.
Jeff, what do you see? Where are we at, and where are we going next 6 months?
Yeah, I'm with Emil, and I think that the inventory cycle that we started out talking about is a big part of what determines what once we get past this initial or this latest burst of optimism and reflation, if you want to call it that, the inventory, how companies are actually able to manage this inventory flood or potential flood, I think will determine a lot about what next year really does look like, at least in the beginning part, as well as all of these artificialities that were front loaded into the beginning part of 2021, they begin to fade more and more and more, sort of revealing the real state of the underlying system where we have much better information than the bad information of the early part of the year. We get better information next year, and maybe we have less misinterpretations of what's actually going on. How do people react to that? Is it a real shock to their expectations? Because I think a lot of people are looking at, commodity super cycle. China's going to be super strong. The U.S. is going into a boom, an inflationary boom. Maybe if we take a step back from those, that actually has an effect as well, a knock-on second-order effect as well.
Well, here's what I see. I see more videos coming from YouTube, Making Sense Eurodollar University, which I dig into. It's necessary knowledge. I really think that if you want to be successful in any kind of investing, you need as much overall global data as possible. But I think in that you need to understand how the gears turn. And there's no other show other than the guy that we won't say, George Gammon, but there are very few places, Macro Voices is really good too, where you can learn how the gears turn. But none as good as I think what you guys do. So I urge everyone, Making Sense Eurodollar University. Emil, am I getting that right?
Eurodollar University, you can find us in 3 places. Number 1, I'm doing my Gammon impression. Number 1, at Alhambra Investments, where Jeff posts daily about what's the bigger picture as well as small e economics and how money, the creation or destruction of it, affects the economy, the socioeconomic scene. Number two, on YouTube, where we do and post our shows. And then number three, in podcast forms, including some of the reading around macroeconomics that I've been doing of other voices that are good writers, good historians.
Yes,
Those are
Emil
the
just
three
did
places.
Karl Marx too, which is, I think it might shock some people, but it's one of those things that you think, well, you're reading Karl Marx, but I think, Emil, you can explain this better than I can. It's really an interesting read, not just for, getting into what Marx was thinking, but it has some definite parables for what's going on now.
It was very well written, very well written. I disagreed at the end. I said, this doesn't quite fit with my worldview. Here's what I think. I'm interested to hear what you, dear audience, have to say. Leave the comments and notes and on the YouTube. But it was so well written that I thought, you know what? Hey, why not read it out loud? I'm just trying to bring various good writers, whether or not I agree with them or not, to the audience.
So there might actually be some gems in that bathwater.
What? Oh, yeah. Yes, there are.
It's a common mistake a lot of people make. Keynes is another one. You think, I disagree with Keynesianism, therefore I'm never going to read a thing by Keynes because why would I waste my time?
Yes.
And Marx is the same way. Marxism is some of the most evil that human imagination has ever conceived, but yet it doesn't mean that everything that Marx wrote is not helpful. There are some things, his critiques of capitalism, for example, line up pretty well with where we are in the world today. And if you're at least just want to understand how to refute this growing trend towards socialism, you at least have to understand where the socialists are coming from. And so, don't just ignore Karl Marx because what was done in his name was utter evil in the 20th century.
Anything that hundreds of millions of people have read is probably worth reading, if no other reason than just to not be one of the people that didn't read it.
Being left out.
I want to thank you guys so much. I know you guys are incredibly busy, but we definitely value the crypto and coffee community really values not only the stuff you do outside of here, but when you guys can get together with us. So I'm going to continue to email you guys and beg you to come back on as soon as possible because this is how we learn stuff.
I will put in a strongly worded note to George Gaiman to get his order and get you on his show.
Well, maybe he'll join us one of these days. Anyway, stay out of trouble, stay in school. Don't do anything my poor insolvent drunk, strung on meth grandmother wouldn't do. Thank you, everybody that managed to stick it out. I think this was great, and we will do it again soon.
Is anyone still there? Hello? Guess I can reveal my deepest secrets. No one's listening, and I've been waiting to unburden myself. Here goes. Yes, true. That